Good evening to all of you. Thanks for dialing into this month's update on the economy, markets, and investments. I'm going to be sharing a screen with the presentation. So let me start off my presentation. So the basic guide to the whole process that we follow is that ultimately returns from the stock market come through the EPS growth, expected EPS growth of the future, as well as demand for stocks, which is otherwise known as valuations, right? So let's just focus on the underlying fundamentals of the economy, which is the EPS, the domestic economy. As you know, from a macro perspective, the GDP data for the first quarter showed a very healthy growth of 7.8%. The sector-wise, we saw agri was at 3.5%, industry at 5.5%, but services showed strong growth at 10%. So services is the one which has held on. Private consumption has improved a bit, and investment was experiencing some softness in that quarter. So then when you look at the other risk factors for the economy from a perspective of the GDP growth, the current account deficit is within sustainable levels, which is very positive. The balance on payment surplus is at comfortable at 2.8%. Forex reserves at 580 billion, close to 11 months of import cover. And if you see, RBI has been able to manage, though the US has risen their rates very sharply, RBI has not, and not even half of the rate increase. So that indicates a good currency management by RBI using the surpluses that we have very judiciously. So our rate hikes have not been as sharp as the US. Hence, from a way forward, the rate cuts in the US shouldn't be as sharply followed by India because we already did not raise it enough, right? On the future outlook for the economy, the PMI actually see manufacturing and services both are well above 50 and trending up. And the economic tracker is indicating that coming months, the GDP should maintain its growth, right? Though the rural economy is experiencing some softness in the coming months with the elections on the way, we expect some liquidity to flow into the rural economy and pick up consumption even in the rural areas. So overall, the consumer sentiment index has come back to pre-COVID levels. And if you look at the revenue growth in the consumer sector, except for the hotel segment, in all of the segments, the revenue growth has broadly held up for the April, May, June quarter, right? In sectors like IT, ITES, insurance, pharma, telecom, they continue to be negative because of the world going through a slowdown. And some of them because they had a high base effect last year, immediate post-COVID bounce back. Right? Employment under NREGA is stable, moderating, but still it's around the last year's level. No big change. We don't expect this to come down because in election season, the government will probably keep that element going. Right? So rural wages, because of the NREGA flow, are expecting an appreciable increase. For the same period, year on year, you can see wages have been growing up in terms of inflationary wages. So this also gives us confidence in terms of the rural demand coming through, right? Property prices, despite all the hike in interest rates, you see the three-city residential property pricing has shown a sharp increase. Except Chennai, Hyderabad, and Gurgaon, all of the key cities have seen a pickup in the new real estate sales. So healthy cash flows are there with customers who are willing to buy these properties. Railway freight, which was going through a decline, has now seen a modest pickup. Air cargo has witnessed a pickup, but sea cargo is still seeing some moderation. Right? And then air passenger has normalized to pre-COVID levels, which means life has come back pretty much to normal. Tourist arrivals, however, into the country haven't come back to the pre-COVID levels. So people are still not yet traveling to the extent that they would in a pre-COVID state, right? On the consumption, you saw the story. So capacity utilization, which after sharply rising post-COVID, seems to have kind of stabilized. So the next leg of growth will happen when next leg of consumption growth happens in the first half of next year, and you would probably see capacity trending up. Right? At that stage, projects under implementation continue to show improvement, and manufacturing and services both are actually driving the growth in the projects, right? So new private investment projects are seeing moderation. So we also already started is going along, but new announcement of new projects is kind of showing a moderation, probably because capacity hasn't gone up as sharply as most people expected, right? But state and center capex both are holding up well and holding up the infra story, right? So, but there is still talk about capex. So people are saying that based on the outlook for the next few quarters, they look at expansion projects. So there is a gap between projects under implemented, new projects being started, and the expected for the new. So we are in a state where People are increasing, turning positive, but yet to really put to ground, private sector capital hasn't really taken off to the extent expected. So that's just future story waiting to happen. So as you can see, the capex sentiment score was moving up, right? Now, the supportive thing for the capex as and when it takes off is the fact that corporate debt has come down, which means the cash flows that corporates have got have been used to pay down the debt. So when they need to borrow again for capex, their balance sheets will be very healthy. So naturally, this reflects in the upgrades, downgrades. You're saying still that 2 times the downgrades are the upgrades, right? So credit quality of the country is in pretty good hands, and hence non-performing loans of banks has come down sharply. So overall, situation is very conducive for banks to do fresh lending as and when private corporate capex shows a strong growth, right? So as we said, NPA ratios are the lowest in about a decade, right? Now, hence, we expect our growth to be stable around this 5.8, 6.3. Now, why are we not seeing a sharp uptick? Because remember, right, this is all domestically driven growth. The export sector obviously has to wait for the world to recover. The world is generally going through a slowdown. So hence, that element is not contributing. But to maintain a 5.75 to 6.25 is an excellent growth considering where the world is at, right? Now, these stock market EPS of the companies, how are they reflecting? So you see the first quarter earnings update, FY24 expectation of 17 to 18 was on track. Quarter 2 earnings upgrade also has been fairly decent. So in fact, market has slightly upgraded this year's earnings from 17-18 to 18-19. So overall, nothing on the earnings side causing any surprises. Individual sectors like metals and cement and oil marketing had a base effect because they had low profits in the year before. So YOY. Banks continue to be contributors, though this time there's a lot of provision write back which has helped the banks to show good earnings. Chemicals is slightly weak, and consumer goods, that's FMCG and IT, remains low growth spaces, right? And overall, the situation is that, like I said, market still expects the Nifty earnings to be at about 18 to 19%. So coming to the stock market's behavior, like I said, it's also not just depends on the economy and the EPS, which as you see is healthy, but on demand for stocks. And what is the situation here? I've taken it going back slightly in time to explain the context. So actually just 20th June quarter of the last year, we saw a very red stock market, after which you saw that it turned green. December 1 month returns turned negative because there was some FI outflow. So as you can see here, FII flows are the ones which are varying and causing the market to give negative returns. Coming into the current year, see again that the beginning of the year was not great because about 28,000 crores FIs pulled out money, and the next quarter to date was up to 34,000 crores. And March, FIs started coming back, so you started some green coming back. And then from the beginning of the financial year, FI flows have been strong, and market also has been all in the green, except that in the month of September, there was 15,000 crores of outflow. And when you're moving on to October, in the month of October also, another 21,000 crores was outflow. But come November, again, you see that the FIIs have again brought in money. Through all this period, remember that domestic mutual funds have been net buyers through the scenario. To explain this volatility in the market, right, we have to look at the who's owning the stock market, but more importantly, who owns the free float. The left-hand side is the ownership, where 43% is with the private promoters, but the right-hand side tells you that free float, the single largest are the FIIs with 33% holding. Now, this is the reason that Indian market is among the most impacted by foreign investors in the world. After Taiwan, China, and Brazil, India is the most impacted by foreign flows. So obviously foreign flows matter a lot. And within the foreign flows, you see on the left-hand side of the pie chart, you see long-term money. On the right-hand side, you see the shorter-term money, which is mutual funds and hedge funds. Long-term money comes based on our GDP growth. Generally, the pension fund, sovereign wealth fund, the short-term is what causes the volatility. And here, if you see in the active management and passive management, the passive come based on an emerging market index. And there, as you can see, India is the second largest member of that index at 15% after China. But over the last 3 years, you can see that India's share has almost doubled. In fact, if you take a longer term time frame from in January 2014, right, India was just 6.4%. We are now 15.5%. So clearly passive flows have been increasing in terms of the component of the index. And hence, if you see that India's weight has been sharply rising. So this is not a cause of the volatility, these passive flows. The active flow. So if you see here, over the last 3 years, 21, 22, and YTD, you see that passive ETF flows have actually dominated the market. right? So India has been getting variability in the active money, but the passive money has been continuously coming. Now, in the active money, what about active mutual funds? Active mutual funds, if you see LSA, has actually increased it to 20% above the benchmark. What is the benchmark? 15.5%. 20% above that means you add another 3 to 4% to that. So clearly, active mutual funds have also been allocating more. In fact, if you see Asia Pacific sentiment, other than Japan, India is the largest overweight in terms of the mutual funds in this space, right? So the third aspect, who causes the volatility, is the hedge funds, right? The hedge funds, who are very short-term players, take a lot of tactical calls. What is it? Because oil prices tend to affect India in a significant way. If you see, when oil starts to rise, because we import 83% of our oil, you're seeing these 8 factors that I've listed here, which causes hedge funds to take a negative view on India. At the same time, when oil prices fall, you see they take the same points to make India into a positive investment. So this volatility is almost entirely caused by these hedge funds, where the single biggest reason, according to me, is the oil price. And there, when you now look at a table over a longer term time period, starting from COVID, the top table tells you that the green tells you FIs were inflows and the red tells you FIs were outflows. And you can see I've charted the price of oil, right? And as you can see, as and when oil drops, FIs bring in money. As and when oil rises, FIs pull out money. And most recently, except for the JFM quarter where the Adani factor led to outflows, if you see declining oil prices in that period led to sharp inflows. From September, oil started rising, and you saw September and October both showing negative. And now, as you see, oil prices recently started declining. FIs again, month to date, have turned positive. So clear correlation, as you can see, in the net flows. Now, mind you, these net flows include long-term flows, include active mutual funds, include passive mutual funds. So if it is negative beyond that, it tells you how much the hedge funds have brought down that. At the same time, the positive, because for a long-term investor like a sovereign wealth fund, right, these temporary corrections don't matter. They are consistent buyers. So whatever you see as a net negative is actually a far larger outflow from a hedge fund, compensated by inflows from passives as well as sovereign wealth funds as well as active mutual funds, right? So the volatility scenario then is entirely almost a hedge fund phenomenon, which, as I said, tracks oil prices as the single biggest factor, right? So now when you look at it here, actually our volatility has been very much easier compared to the world, if you see, because of 2, 3 factors. First is, if you see in this table, I've tracked now the mutual fund buying in addition to the FII flows. So if you look at it here, in the initial part of COVID, mutual funds were sellers. So actually the market didn't rise that much because net impact of the market was brought down by domestic investors pulling out money during COVID. So against 2.8 lakh crore of FII money, 50,000 crores went out because of domestic investors redeeming. So that was the first phase. The rising oil phase, while FIs pulled out money, domestic investors are continuously investing from April 2021. So if you see what are the 2.5 lakh outflow trended only into a 65,000 negative market impact. Then when you come down, apart from the Adani quarter, up to September, right, August, if you take, both FIS and domestic investors are buying, hence market reached lifetime highs just before September. Then in September and October, you saw there were outflows, and November it's reversing. So clearly this domestic buying has been offsetting or double enhancing the FII flow impact. Hence, if you look at it now, the other factor which I was talking about, that both domestic investors, which is the red line, and FIIs, which is the green line, have increased their time in the market in India sharply. So 2001, they were both around 15 to 17 months average holding period. Now they are almost 35 to 48 months, which means what? Domestically, we know it's because of the SIP book rising. So investment horizon has changed. But FIIs also, the component of large sovereign wealth funds has been rising. And hence the impact of a short-term hedge fund has been dominated by this. So that's why if you see Indian market volatility has been much less than otherwise we would have been as a very exposed market to hedge funds, right? So that's why if you see the volatility chart, Indian market's volatility is much less consistently than the world market volatility. So that then brings us, if this is the case, and where are we in terms of valuations? So one of the things to remember here from a valuation perspective is that you will see that right from 2006, right? This free float market cap has hovered around the 35 to 40% range, which means that FIs have been consistently holding a third of at least of our free float market cap for 17 years. With this kind of a consistent buying, which is what this table tells you, we're the only country to receive that consistent buying by FIIs, right? And hence, if you see, India trades at a premium to emerging markets because of this consistent ownership, right? So if you see MSCI emerging market 10-year average, MSCI Asia Pacific, MSCI World, India is always traded at a premium, right? So from a valuation perspective, both against world and emerging market, right? India, barring the global financial crisis and COVID, always has been at a premium. So valuation India being at a premium is no surprise. Valuation India premium is no concern. The variation in the premium occurs because of the oil prices. There's a pullout. But even when they pull out sharply, it's still always at a premium. Remember that, right? So as a result of which, right, if you now then say that against the world I'm at a premium, how am I against my own past? Then you will see that if you look at the 1-year forward PE, and the historic data here has been corrected to actual earnings, so the forward which comes, and current represents the market's expectation, we are trading below our long-term average of the 1-year forward PE, right? This is as corrected by actual earnings in the past. So which means that the market's expectation of the forward earnings by and large has lived up to this chart, and today's market expectation is no different. So from our own historic perspective, I would not say that we are overvalued from a long-term 1-year forward correctiveness taken into account. When you absolutely compare 1 year forward, we are obviously will be trading above. But when you then adjust for the actual earnings as it translated, which is what this graph is, it shows you that India is neither overvalued nor undervalued, slightly, we would say, closer to a little bit of undervaluation, right? So the other thing which is frequently talked about in the market is the earnings yield gap. As you can see, the inverse of the PE ratio compared with the GSEC yield, it shows that the GSEC yield is naturally higher than the inverse of the PE, but doesn't mean that the market cannot go up, because this has been the situation barring 2012-13, when you can see that the gap narrowed. Overall, generally, India has always been at this because markets discounting future earnings, whereas its GSEC tells you about the guaranteed risk-free return that the customer can get. So clearly, as long as a market in the future is going to deliver superior earnings growth, this has not been a reason for not getting returns from the stock market, right? So, and the other thing to remember is that the market's expectation of each year's earnings has been fairly stable. Right in 2021, August itself, market for this year expected 917 EPS. It's now 943, which means that the accuracy of the market in predicting the earnings, right, more or less is constant and is very stable, which indicates that it's a very overall researched and well democratized process of taking consensus estimate. So historically, the market has always lived up to the earning expectation over the years. There is no sharp jump or a sharp drop, right? So from that point of view, now let's move away from the pure large caps to the large and mid caps. And if you see comparison of mid cap with large cap, clearly the mid cap indices have gone up compared to the large cap, and a composite mid and small cap index has gone up even sharper. So clearly you have seen a rally in mid and small cap, which all of you are aware of from a valuation perspective. But to put things into perspective from a month-end perspective, if you look at it in comparison with the previous market highs and market lows, so in the left-hand side of the table, if you see, I've taken December 2017, previous market peak, March 20, previous market low, October 21, the next market peak, and then the current. So if you see here, the index has moved roughly from a current perspective, its 1 year forward P is 20, 22, and 23. And if you look at how this has happened and look at the last slide, where you can look at it from a EPS growth perspective, change versus the 3 periods, right? December 2017, March 2020, and October, you can see that while there has been a small increase in the small cap and mid cap earnings compared to the December 17 peak, if you this narrows down when you compare from the bottom, and in fact from the previous peak it's more or less flat. So what does it mean? It means that from a 1 year forward earnings perspective, mid and small caps have now become more valued than large caps. So if you look at the bottom table, you will realize that today we are trading at a 9% premium on the mid cap index to the large cap, and at 11% premium small cap to the cap. So what will this get offset by? This will get offset by if the future earnings comes better than market expectation. Today, as per market expectation, on a 1 year forward, market is saying that I expect better earnings from mid cap and small cap. Whether that will happen in 1 year or not is what causes a situation of people questioning that is it overvalued or not. If the earnings growth is sharply different, then this will get justified. So why did this happen? Why has this suddenly, without a change in the actual earnings, which you're seeing from October 21, all three have shown 50% roughly earnings growth? Why has the market rally? The rally has happened because of the fact that if you look at it from a perspective of the flows, January, February, March, you saw there was an outflow from FIS. April, May, June, there was a sharp inflow. So immediately the large cap flow into the market caused the large caps to go quite high in valuations, and domestic mutual funds were not strong buyers. They were only 10,000 crores of buying. So in the next quarter, what happened? Domestic mutual funds and FIS both started buying. But because of the valuations, you see that one significant change. And I've taken here the large and mid-cap segment of the market. You can see how many large and mid-cap funds have actually dropped their large cap well below 50%, right? Minimum 35% SEBI prescribes, but have brought it down and increased the mid and small cap. So the rush of money in April, May, June from FIIs made fund managers reallocate from the large and mid cap as well as from the flexi cap. You can see I've circled the number of flexi cap funds which took their large cap component below 50%. So there was this shift of allocation by fund managers because they felt that excessive money was flowing into large caps from FIIs suddenly. And nothing great had changed in India between January, February, March to April, May, June. So that they diverted that to mid and small cap and kickstarted the rally. Now with that kickstarting of the rally, the concentration, you can see, right? 20% of the entire mutual fund active invest is just in 7 stocks. So you can see that when they pull out money from there and divert it to the lower end, you'll see how much the market price goes up because of the sheer lack of free float in mid and small cap, right? Second thing which happened is that FIs increasingly have been investing into our mid-cap fund. So if you see the record inflows, and 40% of the India dedicated money, which came, not the one into passive, what is India specific, came into the mid-cap. So increasingly, FIIs are also beginning to look actively at our mid-cap as an allocation. Where is this coming from? Most likely it is from Japan, because you see correlated to this is a sharp increase in flows from Japan. So the second thing which led to the mid-cap rally was the increasing interest of FIIs in mid-caps, which meant that again fund managers probably sold off some expensive mid-caps and diverted that into small caps. So that explains the second leg. The third leg of the rally happened because you saw that mutual fund investors, right, who saw the past returns after June into July, August, September, started giving heavy money into mutual funds. And if you now look at the monthly flows, I've taken this in September, but October again validates this as I saw the data, that small cap as a segment, starting at 2,000 crores inflows in April, ended up at around 4,000 crores in both in July and August. There was a small dip in September, October again it went to 4,000 crores. So this sudden bunch up in the returns on a 1 year, 3 year basis meant that investor and distributor interest in the small cap segment grew up, and hence you started getting flows. So if you see here, right, the domestic flows have been very mid and small cap centric in terms of the mid and small cap share of the flows. Almost 70% plus of the flows, net active flows, are into mid and small cap. In fact, if you look at it, large cap has seen negative flows, whereas large and mid cap and small cap have got all positive flows. And hence, if you then look at the fact that in the cap curve, 74% is in large cap in a BSE 500 index, which means top 100 stocks are 74%, balance 400 stocks account only for 27%. So the diversion of money flow from large cap to mid and small cap meant that there will be a far sharper rise. And that is what I'm pointing out here, that from July, August, September, mutual funds got almost 50,000 crores of buying. Where did this go? As the market shows, broader market, you can see that the 1 month return of the small cap index is at 4% NSE, and the mid cap is at 3.6, whereas the large cap is only 1.5. So mutual fund managers, because they got flows, and then if you do an analysis of that, you will see that the number of folios in small cap today has overtaken large and mid cap. In fact, 50 lakh folios in 2021 is now 1.3 crore folios. So clearly, lots of investors looking at the past returns have come into small cap. So naturally, when flows reverse, this could turn out to be a bigger risk. But the beauty, and of course, SEBI has been flagging the small cap risk. And you saw that September and October, there were outflows. But what has happened is that you saw the large cap index in October end fall the most. Mid cap index fell a lot, but small cap did not fall. Why is that? Because of the fact that if you look at the SIP flows, they have been growing month on month, as you're aware. But an analysis of the SIP flows tells you that the single largest component of SIP flows, 16% is in small cap funds. And another 13% is in mid cap. That means 30% of the flows are in small and mid caps. And then you have flexi cap, large cap, like multi cap segments also gets another 30%. So fund managers who are getting SIPs into small cap will go and buy the small cap. So right now we are in a sweet spot where any correction in the small cap, there's money in the hands of fund managers through the SIP book to buy. So that explains the current situation, that while there is apprehension that small caps are more volatile, I think the fact of the matter is money flow has been offsetting that risk. And hence you see that even today, small cap returns are, if you look at it from a perspective of a 6-month return, right? You will see the NSE small cap give a 30% return, BSE small cap 27%, mid cap 20%, and large caps are given only 4 or 5%. So clearly the domestic story is one of flows, and this will then now depend on the earnings forecast for small caps rising up to justify this flow pattern taking up the valuations. So that's the situation of the current valuations of the broader market, right? So these SIP flows are what are holding up today. 1/3 of the flows in the industry, 1/3 of the are from the SIP book. So what are the risks that are there? The risk, of course, is the future trend in oil prices, where you can see that 70% of the world's demand for oil is controlled by a large number of small countries who are pumping oil. 30%, which is controlled by OPEC, they decide the price because they don't pump what is required. They only pump slightly short. So that's what caused the volatility in the oil prices in the month of September, right? Then what happens is that you had outflows from hedge funds from there, but as you saw recently, the domestic flows came in and supported that factor, right? So about 3.3 million barrels of shortfall in oil was expected, but what has happened is that now oil prices have started trending down. Why? Because one is that the US has entered into a partnership with Venezuela. They lifted sanctions, so Venezuelan oil is coming in supply. Second is that the world slowdown is becoming apparent. So the future expected trend of oil is also coming down, because if world slows down, then China, which is a big export player, slows down, in which case the oil demand also will come up. So you've seen the recent rush back. The FIS have stopped selling India, and there's a trend towards more positive flows, means that oil is in a declining trend. So that risk today compared to 2 months ago is now less of a risk, right? So this is the Brent crude. The expectation now is that Brent crude prices are likely to be stable into the year ahead. In fact, as much as till March 25, people are expecting that there will be not much change in the oil prices, which is the best news from an India perspective, because you're likely not to see any panic reactions from hedge funds on this matter, right? So now I will just skip these slides because they are the risk of the monsoon we all know, but right now it's now well discounted, because even with the monsoon not so successful, overall inflation has been under control, right? So going ahead from here, looking at the flow pattern on a world economy, interest rate and currency, because that's very critical. You're seeing that India and the emerging Asia are far the fastest growing spaces. India and China, in fact, dominate the additions to world GDP growth. So from that point of view, the US, which is upgraded recently, has expressed that inflation seems to be coming under control. So markets now increasingly seeing a rate cut scenario in the second half of the year. which is good news from an emerging market flows and India perspective, because cheaper money means more money will flow into riskier emerging markets, right? So let me go ahead from this, the fact that I want to point out that liquidity wise also, there is ample liquidity in the economy. There's about $8.5 trillion in the Fed balance sheet and about $26 trillion in the world balance sheet. So liquidity is not at all a challenge as far as the emerging markets are concerned, right? So from that point of view, if you see, right, from a gold dollar index, right, is if you see interest rates rising, dollar index rises. If you see interest rates stabilizing, dollar index falls, right? So as you can see, after a sharp rise, now the dollar index is beginning to stabilize. So from that point of view, you will see that the alter ego of the dollar is the gold prices, right? So from that point of view, if you see gold spot, right, has been seeing a positive return. Why? Because a weakening dollar is a contra to the gold. So when dollar strengthens, people tend to put more money in dollar and less to gold. When dollar weakens, people take their money away from dollars. The sovereign wealth funds put money into gold. So gold has been seeing a uptick because of that, right? So apart from that, let me now move on to a quick thing in terms of, I think, the international scenario we have now covered. So then when you see the world stock markets, right, they were negative in a period when the dollar was rising, right? Because interest rate rises, equity markets don't like. But now with the dollar stabilizing, we should see that world stock markets also start improving, right? So where we are now, that back equities are now into a buy zone worldwide, right? They had gone to extreme sell earlier, but now they are back to a buy zone, right? And from that point of view, from an equity market short-term outlook, right? So one of the things is to compare that for a US investor, he's comparing a 4.47% US yield with a 4.11% inverse PE from India. But like I said, if the growth continues, then this is justified. So I think it's entirely boils down to the Indian growth scenario. And from a market short-term outlook, Morgan Stanley had come out with this ratio that if the Indian earnings season is discounted at 21%, if it goes up to 22, you'll see a 5% pickup to the Sensex. But if it's a 25% earnings, right, then you could see a 20% uptick. The reverse is obviously true. If the base case earnings drops to below 17, 18, then it could be even a 20% correction. But I think that today we are where the earnings season is coming out fairly strongly. I don't think a downward correction in this earnings is expected. So the outlook on the short term, barring certain event risks, are fairly positive, right? And even when corrections happen, lifetime highs lead to corrections, right? You've seen that the average fall has been anywhere between 20 to 60%, but with a good earnings growth, I don't think we need to now worry about the bottom. But even if people have returned, have invested at the highest all-time highs, you can see that there's 2/3 chance that they will make a 7% inflation beating return. So markets being at lifetime highs is no reason to make investors stop investing. It is definitely a better perspective. I will skip this section on medium term because I think all of you have heard this story a lot in terms of the India growth story, the China +1. So I think we'll leave that for another day if there are fresh developments. But the long-term India story remains very solid. But what I want to focus on is that from a per capita income, India's doubling of per capita income, not only by the end of the decade from 2003 to 4,000 has two positives for India. First is, of course, it will give a consumption boost. But more importantly, it's also going to, this is the consumption story here, which I've talked about in the past. But I want to also focus on the fact that there's a huge consumption story based on this, but from a savings perspective also, right? If you see, there is this real estate demand which is coming, which is one form of saving, right? Then there's also the mutual fund investment, which will come and support. So I wanted to say that from a perspective of cities forecast, for example, over the 4 year, India for the next 4 years is going to be the fastest growing. So from a perspective of that, right, we are expected to become the third largest economy in the world. And because of which our share of world GDP is slated to go from the 3.2% to a 4% level. So that sovereign wealth funds will continue to increase their allocation to India. So the valuation support for India's growth story is going to come from an increasing allocation from sovereign wealth funds, right? And this is supported by the fact that the downside risk from India to any global events of GDP decline is the lowest in the world, along with Indonesia, right? So when a foreign investor looks at India, he just doesn't look at the growth, but what is the variability in the growth, right? So there's a comfort from India from this perspective. So if you now look at it as a stock, if you look at a country as a stock, for an FII, India, because of this less variability in the growth path, is actually turning into a defensive stock, which means automatically allocations will increase because people like to seek safety in a growth perspective. So India's flows from foreigners should consistently be on a rise. But the rise in per capita income that we spoke about will also translate into higher savings. As shown from the previous time that you had a doubling of per capita income, bank deposit went up 3 times. So this next doubling, which we are expecting to take place by the end of the decade, you will see maybe 3.5 times increase in savings. The key issue for us is that this savings is going to get boosted because India's youth population means that there are less number of people depending on these people to earn for them, because more of them are going to be in the working age scenario. So from a perspective, we are already in a clear situation where from physical financial mix is changing in favor of financial. In 2014, it was 55% physical, 45 financial. It's already reversed in terms of 60-40 and should only increase in the coming years, right? But the mutual fund share of this kitty, though it's grown at 23% per annum, has gone from 1% to 2%, still leaves 90% there left for us to join. And a declining inflation scenario, which we're going to see moderate inflation, means that the tendency to put more in financial will be enhanced. So while real estate will see its own growth path, you will also experience this. So household financial assets have a long way to go. India, as a share of our total financial assets, and MF assets to GDP is still in the low double digits. Long way to go. So the increasing per capita income of our country should see increasing savings, and hopefully we are seeing the trend that individual share of assets in the mutual fund industry has grown from 45 to 60, and it's winning the battle against bank deposits. So in 2010, we had 13.7% of mutual fund assets as a proportion of bank deposits. That's already gone up to 22%. So 50% increase in that. So we are winning the battle against bank deposits. But in the coming years, with the pie also increasing and our share increasing, you should see strong domestic support for the stock market itself, taking the valuations and the prices higher, right? And you have a lot of scope across India from a perspective of the penetration of equities. You can see apart from Gujarat and Maharashtra, no other state is even 5 to 6% of its investment in equity. So there's countrywide, there's a huge scope. It's the AMFI mutual funds, EA, and all these education campaigns are going to increase it. And so we can expect strong domestic support to continue to take India's stock market higher and higher. Right? So from that, I just want to point out that this slide I wanted to help you all with as distributors to show to your customers that over the medium term, on a 10-year return basis, nowhere in India has the real estate market delivered better than a double-digit return. Right? So while people are interested in real estate and will put their money, you should also make them aware that in the long run, as a 10-year return, real estate goes through its periods of sharp high returns and then low returns. Over a decade, you can see that the stock market clearly will be able to give a better return than real estate. This is just a tool in your hands to convince your investors about this. At the same time, you've got to bear in mind that every year's earnings growth in the stock market is not reflected in stock market returns, because markets discount the future, markets are a function of flows into the country. So, but over a long period, it definitely beats the EPS growth and nominal GDP growth, but year to year, there would be always gaps between the two. So that's what I want to show. So from a medium-term outlook perspective, right, first thing to remember is that India is just coming out from the bottom of a business cycle, which is going to last for the next 7 to 10 years, right? So India is right there at the beginning of the upcycle. Why I point this out is this is very similar to the 2003 to 8 journey, when you had a boom in the economy and a boom in the stock market. I've highlighted that in blue, right? So we are at that stage, and because corporate profits as a share of GDP or whether they're lowest in COVID and have started rising. And in 2003 to 8, you saw from a very similar low point, they rose all the way to 7 to 8% of GDP. We are now at about 4% of GDP and on the rise path. So clearly, profits share as GDP grows, you should expect EPS obviously will grow faster than GDP and stock market to keep pace with that, right? So after a decade, the Nifty 50 is today entering a value creation zone, right? So from that point of view, over the long term, year to year, it may not match, but over a 15-year point of view, if you see in various countries, including China, South Korea, and in India, the nominal GDP has always been beaten by the market cap's growth, right? So ultimately, with India on the beginning of a bull cycle, you should expect the market cap growth of our country's stock market to far outbeat the GDP growth expected over the next decade, right? So from that point of view, coming to the investment side of this, the broader cap curve orientation, domestic orientation, these are the two factors to remember. Domestic way, I'm saying, because the world is going through a slowdown, external oriented sectors may not experience that kind of growth. But domestic oriented sectors, because of the PLI plus one, China plus one strategy, domestic growth getting a boost should be delivering better alpha than an international oriented portfolio. Second is a broader cap curve. Why? I come back to this large cap, mid cap, small cap story. And if you see here and you split our economy into various business cycles, right? When you look at it from a perspective of the 2003 to 8 good cycle, 8 to 13 bad cycle, 13 to 17 good cycle, 17 to 20 bad cycle, and then 20 onwards the good cycle has started. You can see here that if you plot those periods, you can see that the bad cycles have led to always small caps losing much more than mid cap losing more than large caps. Whereas in a good business cycle, the bottom table tells you that when you last the period of the cycle, always small caps are given better returns than mid caps, and mid caps are given better returns than large caps. So we are today at the beginning of the economic cycle. So according to that, right, I would say that the allocation should be more, but given that in 6 months' time, we have an election, we have an intermediate election result now, then you have the budget, interim budget coming, and all this volatility, you can start off with a large cap oriented allocation, because I expect that FIIs, when they first come in, the large cap valuation will go up. And then as the domestic story is beginning to play out, just around the election time, you should shift your portfolio to a mid and small cap portfolio, because of the fact that we are seeing that from a rise in the perspective, right? This exactly, the story has already begun to play out. From the bottom of the COVID, already small caps have delivered 50%, mid caps 40%, and large cap 30% return from that point to now. So as the cycle plays out, this story will get strengthened due to two reasons. One is that as the economic cycle grows, you'll see mid and small cap companies' earnings beating expectation. Second is you're seeing a significant shift in the flows, that SIP books are being shifted towards mid and small cap. So this consistent buying support for mid and small cap should make sure that as long as the economic story lasts, you are going to see greater buying power and greater investing rationale for mid and small caps to come and outperform the large caps. So that should be the ideal medium-term allocation, as 30% large cap, 40% mid cap, and 30% in small caps. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.